Sola and Kemi started their civil service jobs in the same month. Same salary. Same allowances. Same Abuja cost of living. 3 years later, Sola had built an investment portfolio worth roughly 4 times her monthly salary, simply from the money she had been setting aside every month. Kemi, on the other hand, had a savings account that had grown by less than 3%. Same income. Completely different outcomes. The only difference between them was one decision Sola made in her very first month. A decision Kemi kept postponing. And that's what this video is about. Kemi wasn't careless with money. She saved consistently. She never missed a month. She was doing exactly what everyone told her to do. Keep your money in the bank. Stay safe. Don't take risks. But one Thursday evening, Sola showed her something that changed everything. She pulled out her phone and showed Kemi 2 numbers. The first number, Nigeria's inflation rate, hovering between 28 and 33% over the past year. The second number, the interest rate on Kemi's savings account, between 1 and 4% per year. Sola looked at her and said, every year you leave your money in that account, you're losing roughly 25 to 30 percentage points of your real purchasing power. The bank gives you 3%. Inflation takes around 30%. You're moving backwards. Kemi stared at the numbers. For 3 years, she had been saving faithfully. Saving proudly. And all the while, she had been quietly losing a large portion of her money's purchasing power every single year. She wasn't building wealth. She was funding inflation. That night, she asked Sola one simple question, so, what do I do instead? Sola didn't give Kemi a lecture. She gave her an analogy. You know how Dangote built that cement company, she said. At some point, he needed more money to expand than he could raise alone. So he offered the public a chance to own a small piece of it, in exchange for their money. That's a share. That's a stock. When you buy a share in a company listed on Nigeria's Stock Exchange, officially called the NGX, you become a part owner of that business. If the company grows and becomes more valuable, your share grows in value too. If the company makes profit and decides to reward its shareholders, it pays out a portion of that profit directly to you. This is called a dividend. Historically, well-selected Nigerian stocks on the NGX have delivered returns ranging from 15% to over 40% in a single year, compared to the 1% to 4% you get from a savings account. That's not a guarantee. Markets go up and they go down. But over time, patient investors who stay consistent have consistently outpaced inflation in ways that savings accounts simply cannot. Kemi understood. Her savings account was a waiting room. The stock market was the actual journey. But how do I even buy a stock? Kemi asked. I'm not a banker. I don't know anyone on the trading floor. Sola laughed. Kemi, I bought my first stock from my bed. In my pajamas. At 11 p.m. That got Kemi's attention. Show me, she said. Sola opened an app on her phone and handed it to Kemi. The interface looked simpler than her banking app. This is how it works, Sola said. 4 steps. That's all. In Nigeria, to buy stocks on the NGX, your ownership has to be recorded officially. The body that does this is called the CSCS, the Central Securities Clearing System. Think of it as the land registry for shares. You don't visit them directly. A licensed stockbroker does that for you, and today, many of them operate as apps you download on your phone. Kemi looked at Sola's app. How long did registration take you? About 15 minutes, Sola said. NIN, BVN, passport photo. That's it. Kemi downloaded it before they finished their conversation. How much did you start with? Kemi asked. That's the wrong question, Sola said. Kemi frowned. The right question is, what percentage of your salary are you willing to commit every single month, before you touch anything else? Sola explained, Most serious investors follow a simple principle called paying yourself first. Before rent, before groceries, before weekend plans, a fixed percentage goes into investments automatically. For a beginner, even 5% to 10% of monthly income is enough to build something real over time. Kemi did the math quietly in her head. 10% of her salary, invested consistently every month, compounding over 3 to 5 years, it wasn't a fortune. But it was a start. And it was more than the near-zero real return she was getting from her savings account. "Okay," she said. 10%. I can do that. Most people make one mistake when they start, Sola said. They buy stocks the way they buy data, they just go with the brand they recognize. Kemi laughed nervously. That was exactly what she had been planning to do. "So how do you actually choose?" she asked. Sola said she asks 3 questions before buying anything. First, is this company consistently profitable? Not just last quarter. Look at earnings over 3 to 5 years. A company that makes profit in good times and bad times is far more reliable than one with one spectacular year. Second, what is the price-to-earnings ratio? The P/E ratio tells you how much you're paying for every unit of profit the company generates. If a company's P/E ratio is significantly higher than others in the same industry, you may be overpaying. A lower P/E relative to peers can signal better value. Third, does it pay dividends, and has it done so consistently? A company that returns 30% to 60% of its annual profit to shareholders as dividends, year after year, is usually a company with real financial discipline. That's the kind of business you want a piece of. Kemi was writing notes on her phone. And for someone just starting, where do you even begin? Blue chips, Sola said simply. Large, established companies with long track records. On the NGX, names like Dangote Cement, Zenith Bank, GTCO, MTN Nigeria, BUA Foods. Not because they're perfect. But because they have histories you can actually study. You can see how they performed in 2020 when everything crashed. You can see how they recovered. That data is your teacher. One last thing, Sola said. Don't put everything into one company. She showed Kemi a simple ratio she used when she started. 60% of her investment went into large, stable blue-chip stocks, lower risk, slower but steadier growth. 30% went into mid-sized companies with strong growth potential, slightly more risk, but higher upside. 10% went into higher-risk picks she had researched carefully, companies she believed in but understood could disappoint. That way, Sola said, if one stock drops, and sometimes they do, it doesn't destroy everything you've built. Kemi stared at the ratio. It wasn't complicated. It was actually the most logical thing anyone had ever explained to her about money. Why didn't anyone teach us this in school? She said quietly. Sola picked up her drink and smiled. That's exactly why I told you. 6 months after that Thursday evening conversation, Kemi's portfolio had grown by approximately 18%. Her savings account, in the same period, had grown by less than 2%. But the number wasn't even the most important thing. The most important thing happened on a random Tuesday morning. She was checking her investment app during her lunch break when she saw a notification. Dividend payment received. It wasn't a huge amount. But it was money that had appeared in her account without her doing a single hour of extra work. She called Sola immediately. I just got paid for doing nothing, she said. Sola laughed. Now you understand why I started. That was the moment Kemi stopped thinking of investing as something for rich people. She increased her monthly contribution from 10% to 15% of her salary. Not because she suddenly had more money. But because she finally understood where money actually grows. Now, an honest word before we close. The stock market is not a guarantee. Prices rise and prices fall. Some companies disappoint. Some years are harder than others. The 18% Kemi earned is not a promise, it is an example of what patient, diversified investing can look like. Never invest money you cannot afford to leave alone for at least 1 to 2 years. And if you ever feel unsure, speak to a licensed financial advisor before committing. Here is your challenge this week. Open one investment app. Just open it. Don't even fund it yet, just complete the registration. That one step took Kemi 15 minutes. It changed the next 3 years of her financial life. If this video gave you something valuable, share it with one person who is still stuck in the savings trap. And if you want to know exactly which Nigerian stocks are worth looking at right now, that breakdown is coming in our next video. Subscribe so you don't miss it. Smart moves. Real wealth.